So the code on how to identify breakouts in charts. For that, for example, we can do trading as long as it respects the trend line. The trade that breaks the trend line, we will have a break to the upside. Now, how do we measure the breakout? We can measure the strength in a breakout to determine if it is a breakout or a fake out, because as we discussed earlier, we have two types of breakouts. One is continuation and the other is reverse. And there exists a third party, which is the brother of the breakout. The little devil, the mischievous brother who bothers us so much, zeroes out our account. We call it a fake act. That mischievous brother.
What is his job? His job is to say that I am starting to go up.
Come on, come on. When it starts going up with it, it goes down. It says, now I am starting to go down. You go along with it. It slips away. This is a fake out. So how do we distinguish between a fake out and a breakout? We will use so-called indicators to help that. Now we have learned divergence in Magda, and in this term we are going, our trend line will also break. Our support will also break. We need to check if the MACD is showing divergence according to bearish. If it is showing, it means the trend has indeed become weak. It's like a filter that helps you distinguish between breakouts and fake outs. And the second thing is we can use RSI. In RSI, we have to look at overbought and oversold conditions. And when we reach overbought and oversold conditions, the chances of reversal increase from there. So we have to keep it. We have to look at the trend line. We have to look at support and resistance. Then we have to use indicators with it to identify in a breakout. Now, for example, if we end up in a fake out, we have realized that the movement that happened is not a breakout. So what do we have to do? We have to trade against it. If the breakout is against the trend, then we should not go against the trend. So what do we have to do? We have to fade the breakout. That is fading the breakout. Fading the news. Fading is also a way to trade spikes. So what do we do? If we think the breakout happened upwards and that is a fake out, we will sell. If we think the breakout happened downwards, but the breakout is not a breakout, it was a fake out, then we will buy. So how do we identify? We have to look at the environment of the rows and vertices. If the market is ranging or it's an off-timing session where volatility is not found, for example, the Asian session, depending on market conditions, because when Trump is in power, the Asian session and New York time are very volatile. When Trump is not in power, the Asian session is not that volatile. The second half of New York is not that volatile. So we can use these timings. The session timings, we learn to identify the time where there will be a rollover trading environment. Then we have indicators, moving averages, Bollinger Bands, and ATR that we can use. There is insufficient movement here. You can trade against it there. Then the second thing is that when we draw a trend line, if the price has gone above the trend line, by rules it should be a breakout. But what happens is that if the price has crossed above the trend line, it has started to consolidate. There isn't enough momentum in it to form high candles. Suddenly, it might have started that much consolidation. At the beginning, it means that the breakout happening doesn't have enough momentum to continuously move forward. So most probably this breakout will be a fake out. So we just sell it again. And the second is the fake out. How do you predict the potential pattern of a fake out? Just to set it. They don't wait for pattern confirmation. They say now it's a double top. Head and shoulders are starting to form. The potential is starting to form. When they see potential, it is often fake. So when the pattern starts to initiate, when it's about to fully initiate, the price reverses and goes in the opposite direction. In this, you can see examples of head and shoulders, double tops and bottoms. So we have to be very careful. For this reason, always use a stop loss. Our trading game is a game of probability. Nothing will work 100% of the time. We just have to choose something that works 70% of the time. Breakout trading and fake out trading are great strategies for the toolbox. What did we understand in this chapter? In this chapter, we understood how to identify breakouts and how to identify fake outs. Then we learned how to use volatility indicators and chart patterns to trade breakout power trading opportunities. And we must always practice risk management and disciplined trading. The more this exercise is done, the better, because people lose in trading due to lack of risk management and disciplined trading, and there is no reason for this. And remember, fading trade can be profitable, but you have to be very careful and manage the risk. Why? If a fake out becomes a breakout, then you will be in loss, of course.